Hi, I'm Richard Vague with Tycos. Today our focus will be on who owns U.S. federal debt instead of the typical analysis of the amount of debt owed and concerns regarding the government's ability to finance its growing debt, which is something we talk about from time to time and we'll cover again at some point. Let's take a look at who owns the Treasury debt. About 1/3 of the debt is owned by foreign countries. Quick note on China. Although you might hear that we are heavily indebted to China, it's actually only 3% of the total, or about $816 billion, and less than we owe Japan. In fact, China's holdings of Treasury debt has been trending downward since 2013. And after the UK, Luxembourg, and Canada, 100 or so other countries hold a smaller portion of foreign-held debt. So why do foreign countries, largely countries who have a trade surplus with the U.S., hold so much U.S. Treasury debt? The main reason is our huge trade deficit. We buy more stuff from them than they buy from us. So they end up receiving and holding a lot of dollars, which they have to do something with. The easiest and safest thing for them to do with those dollars is to buy U.S. Treasuries, though they can also buy other U.S. assets. Since 1945, our cumulative trade deficit is $16 trillion, and nearly 90% of that has been incurred since the year 2000. So, for decades, we were fairly balanced from a trade standpoint. It's gotten worse and worse since the 1980s. So with this $15 trillion in surplus dollars they've received, they've invested about $8 trillion of that in Treasury securities and the rest in things like stocks and corporate bonds. The trade deficit is something we worry about, and we would greatly prefer a balanced trade position. One reason is that we pay for those net imports with private sector debt. So our private sector has trillions of dollars in debt it would not have if we did not have this trade deficit. Although people talk about tariffs and other strategies as a way to reduce our trade deficit, the best way, candidly, is by expanding our R&D investment to make better and more sophisticated products and services. Things like AI chips and genetically re-engineered DNA are two great examples of this. The current trend towards reshoring of manufacturing will also help reduce this trade deficit. Stated simply, if we want other countries to hold less of our debt, we should reduce our trade deficit. By the way, the textbooks will tell you that other countries hold treasuries as a form of reserves and to facilitate the settlement of global payments. And that's all true, but the main reason for the large amount is this trade deficit. You'll also notice that a significant portion of overall Treasury debt is held by the Federal Reserve. Buying government debt is something central banks like the Fed do, mainly to provide market liquidity and help stabilize the economy in uncertain times. During the pandemic, the Fed used open market operations to purchase a lot of Treasury securities for these reasons. We would note that when the Fed purchases bonds from the non-financial sector in the secondary market, it increases the money supply. However, the Fed has recently and slowly started to sell off these bonds. That's in the last year or so, and that reduces the money supply. While we're on the subject, we want to touch on the oft-stated belief that government debt or deficit spending is, quote, printing money. It's a misconception. When the Treasury issues debt, it actually reduces the money supply. Deposits go down when people or businesses or others spend their deposits to fund those purchases. That money actually goes into the Treasury's checking account at the Fed called the TGA or Treasury General Account. However, the government does not issue debt unless it intends to spend it out of the TGA, and that spending shows up as increased deposits in the accounts of those recipients of government checks. So in theory, while it could play out differently, in actual practice, the net impact of government debt and spending on the money supply is effectively zero. Instead, it's primarily bank loans that increase the money supply. So the Treasury issues debt, deposits go down, it immediately spends that money, deposits go back up. The net effect is effectively zero. Next week, we'll look at the impact of the Treasury's interest payments. That's it for this week. Thanks.